In this video, I want to just talk a little bit about some regulations. I don't think regulations in general help us a ton in understanding how business works, but I think it does provide a structure, if you will, an understanding of the rules that are in place. So let's first start with something called Glass-Steagall, right? This prohibited information or institutions that took deposits from some other activities. So what this essentially did is it said that banks, insurance companies, investment banks, brokerage firms could not be the same company. Now, this act was repealed during the Clinton administration. What the Glass-Steagall repeal created, though, is it now created these mega banks. The phrase "too big to fail" was created because this particular regulation was unwound. There is something called the FDIC, which is an insurance company. So essentially what this does is it is an insurance so that if the institution goes belly up, the investors are saved. They have some safety with their deposits. And there are certain rules that changed throughout time. The Gramm-Leach-Bliley Act, this allowed mergers to happen. This happened after we had repealed the Glass-Steagall Act. Now, this act allowed companies to merge together. And again, this created the too big to fail issue. The Dodd-Frank Wall Street Reform Act, again, this realigns the duties of agencies, right? It requires existing and new agencies to report to Congress regularly. What this basically says, look, there were agencies that were supposed to be looking at these institutions, but they did not, on a regular basis, report back to the oversight committees. So that's what they were blaming part of the challenges for the last couple of scandals, right? The big corrections in the market. They allowed them to happen. There are some regulations that are very important, though, that are in place. The Securities Act of 1933, this is the act that regulates the primary market. So all of the rules associated with issuing stocks by a company or bonds, it could be stocks or bonds, all of those rules are determined and set forth in the Securities Act of 33. Sometimes it's referred to as the Information Act. The Securities Exchange Act of 34 basically covers the secondary market. It created the Securities Exchange Commission and provides all the rules of trading, including those about inside information trading. So this Securities Exchange Commission, we've talked about it a lot. The idea here is it's supposed to enforce federal securities laws. Now, some might argue that it doesn't do a good enough job, that it doesn't provide the types of oversight and regulation that we really need to keep our markets stable with a reasonable, consistent pricing. So the reason we talk about these regulations is that from time to time, there are challenges in the financial markets, right? So there was in early 2008, there was what we refer to as the mortgage crisis. So how did this mortgage crisis happen? Well, there is a process called securitization. Banks can only lend out so much money. So when they've lent out as much money as they can, how are they going to continue business if they can't lend more money? So what they do is they sell mortgages to companies. These companies give the banks money, and now the bank can go out and lend more money. So it facilitates the cash available, if you will, for lending dollars. And these companies create what are referred to as mortgage-backed securities. There are several of these. Fannie Mae, Ginnie Mae, Freddie Mac are the three big ones. And essentially what they do is they buy the mortgages from banks and they give the banks money. Well, where did they get the money to give to the bank? They sell bonds, again, that are referred to here as mortgage-backed securities. So the risk of these is the mortgage that people take on homes. So what happened in this crisis is that home prices were rising like crazy, right? So the value of homes was going up, and there was a very low default rate. But what happened was mortgage brokers, and hopefully this doesn't sound too terrible, but mortgage brokers in general created this entire crisis because they were giving loans to people. Quite frankly, some of these people didn't even have jobs. So they couldn't provide documentation that they had income that could cover the mortgage payments. So what happened is because of these relaxed standards, and they refer to something as a subprime mortgage, that these mortgages ultimately started to fail when the business slowed a little bit. So the business slowed, people started having trouble paying their mortgages, and they started to default. And again, that's the risk of these mortgage-backed securities. Now, subprime mortgages, by definition, are riskier mortgages, but lots of people took out subprime mortgages. I had a subprime mortgage when I bought my house because I didn't have 20% down, but I could afford, and I had income to prove that I could afford, the mortgage payment that I had. That's not what caused the problem. The fact that there were subprime mortgages, that wasn't the cause. The cause was some of the people that were given mortgages, as I mentioned, could not afford mortgages. They shouldn't have bought a house. So what we end up showing is that the housing price index right around 07, 08 took a terrible tumble, right? Most people lost a tremendous, this is an index. So the index dropped from what? 225, give or take, down to 150, right? So it dropped 75 basis points, right? 75 divided by 225. I mean, that's well over 30% drop in the value of homes. So what happened? So people now, they can't afford the home, so they're just abandoning houses. So now we have this huge supply of homes, most of them in foreclosure. The world's in turmoil. Now, since this time, right, and it took a long time for us to get out of this, as of recent, the market has started to climb back up. So if you stayed in your home, I stayed in my home, then eventually the value of your home came back, and now you could actually show equity in your home again. So what this did is it created a crisis of confidence, right? Banks, in particular mortgage banks, right, were really injured by this, but it was a mechanism of their own making. Now, only 3 banks failed, right, in 07, 25 in 08, 140 in 09, 157 in 2010. But now, recently, since 2015, bank failures are back in the single-digit types of range. So banks are coming back, even though they were pretty badly damaged. those banks that failed were banks that were heavily invested, not in subprime mortgages. And again, this is way out of the range of this particular class, but how they were reducing the risk and how they were marketing some of these securities was not regulated. So there were some challenges when people started to fail and those securities themselves failed. So what you can see is what happened to bank stocks you can see from 07 down to 08. The index value went from the 1400s down to the 300s. So there was a tremendous drop in the value of banks because of this entire mortgage process. So what has happened since then? Again, businesses, banks were in a lot of pressure, so they had to tighten their lending standards. So that meant it was harder for business to get loans. It is still pretty difficult for small businesses to get financing. So what did they do? So the bigger companies, they didn't invest in things. They cut back on expenditures, right? Economic activity in our entire economy came to a slower pace, right? We went into a major recession. Why? Because companies couldn't borrow to expand business. So again, this financial market crisis is hopefully it's once in a lifetime because it relates to mortgages. But if you think about what's happened in the last year since COVID has happened, we're in another midst of a challenge, right? We now have extremely high inflation. We have an economy that's not growing as fast as it used to. Prices are just out of sight. So how are people going to buy things? The answer is they're not. So demand is coming down, but supply is the issue. There's not enough supply of product for the demand that people have. So that's what's creating this huge inflationary pressure. Not to mention all of the funds that have been funneled into the economy by the most recent events, right? In 2020, COVID happened. We had to help people, right? So we had to print some money. We had to spend money to help people. But since 2020, there's been a consistent flow of money into the economy from the government, and the government doesn't have the money. So they're just printing money. That is creating all of these inflationary pressures, which, depending on who you talk to, most people are thinking that at the very least we're going to be in a light recession. Some are predicting that we're going to have a major recession just because of the fiscal policies. Again, this is way beyond what this class needs to be concerned about, but it is an issue of the current day economic crisis. Hope you liked the video. I'll be talking to you soon.